the typical investor, when they go online, they'll see someone's crazy returns. It'll say, I made $500 from $5, whatever it's going to be, some crazy exponential return. And then that sucks in a lot of people that don't know what they're doing. When I started out, that sucked me into, there's a guy called Tim Sykes where you subscribe to his community, you get a text message on your phone the second that he does a trade alert, and he does a trade alert, you get the text message, then you try to follow his trade. And then the problem is he does this on like small cap companies. So, if he puts, say, $1 million into this company that's a $10 million market cap, his money will move the price of that company so much so that when his huge following comes in, that pushes up the price even more. And then he kind of just sells on them and uses them as exit liquidity. So I tried that, lost a bunch of money doing that, but I knew there was a better way. So then I kind of got on like a Warren Buffett kick where it's like value investing, buy and hold forever. Don't let your emotions get in your head. Um, so probably, what is it, 2014 now? Probably about 7 years ago is when I switched to like the Warren Buffett kick. Um, that's when, I started buying a lot into the S&P 500 and I started putting into the NASDAQ too. So pretty much like 50-50 between VOO and Triple Q. QQQM is better though, by the way, because the fees are a little bit less. But, I just started putting money into that and just kind of forgetting about it. I happened to get in at a good time when the market was, in the mid stage bull run. So it went up a lot. And to get to that first $100,000 that I had in there, that was the hardest $100,000 because there's so many obstacles that you have to go through to just get to your first $100,000. And I know everyone's going to say like $100,000 is a crazy amount of money, but when you do certain things day in and day out every single day, you'll like blink your eyes and in a couple years you'll be like, holy cow, I'm at $100,000. So it's possible. Um, I had a day job. I was making roughly roughly $100,000 at the time. I had a fiance. She was in school. She was not working. And I know a lot of you guys are going to say, well, dude, you made $100,000 a year. That's a lot of money. It is a lot of money, but I lived in a very high cost of living area. So it didn't really end up being a lot of money at the end of the day. I lived in the Bay Area in California. So everyone knows, it's really expensive to live there. The taxes are high. So $100,000 in the Bay Area is really not a lot of money, I promise you. But it kind of clicked one day in my head where there was this guy that I was working with where he was probably like 75 years old. And I'm like, why is this dude like begging the boss for overtime, picking up graveyard shifts and working day shift the next day? I'm like, dude, like you're 75, you only have, a few good years left or whatever it may be. And he's like, I didn't save for investing or I didn't save for retirement. I didn't invest anything. 2008, I got wiped out with the housing market stuff. He just didn't plan for his financial future. So now he's paying the price. And I'm like, I don't want to be like that. So that's why I started taking this stuff super serious. So I was piling into Triple Q and VOO. I got like my first $100,000 in there. But some of the obstacles that I want to hit on that don't exist beyond $100,000 is the price you pay for gasoline is the same. The price for your rent is usually the same. Like there's so many fixed costs in your life that whenever you have beyond those fixed costs, it's all icing on the cake. So, you know, first 100K was obviously the hardest. And the psychological aspect of having your first $100,000 in the stock market, it's super, super hard. Let's just say I was making $50 an hour at my day job. If I would work a 10-hour shift, I would make, say, $500 before tax. But if the stock market would go down, say, $500 that day, like my portfolio would drop by $500 in that day, I would be like, what the heck? I'm working for free right now. And like, it was hard to cope with that starting out. Now my portfolio fluctuates like $50,000 a day and I don't even care. So, and I think, I kind of go on tangents and go all over the place, but, the information is key because if I kind of like had this podcast when I started, it would have helped me so much from someone that has actually done it, not someone that just says, I made $1.5 million overnight because I got lucky on a penny stock. Like this is the legit way to do it, in my opinion. Um, you look at pro athletes and people that win the lottery, they often go broke because they don't have the emotional psychology to manage their money. If you can't manage $5,000, you can't manage $5 million. And it's a progressive, scale as you go up. Like I was struggling to manage $100,000, but then I finally got my emotions in check. Then it's slowly 100, 120, 150, 200, whatever, as it goes up. But if I would have went from 0 to 1 million and saw fluctuations of $40,000 in a day, I would have self-destructed and just lost it. Like I wouldn't have been able to do it. I eventually got into selling put options and, sometimes buy call options. I'll get into that in a minute. The key is you need to have the key in the stock market, in my opinion, is you have to have confidence and conviction in what you do. I talked about it on my YouTube channel and X sometimes too, where it's like people are like, well, how do you get conviction? How do you get confidence? And I don't think I'm a cocky person at all. Um, but like, let me flip it on you. How does a pro fighter get conviction that they're going to go into this fight and win? They train, they practice, they run, they're physically fit. But if I
Mindset
go into
too.
that, yeah, mindset, they beat other people. They're 50-0 right now, whatever it is, like Floyd Mayweather. If I go into that fight right now, I have no confidence, no conviction, no mindset because I'm not a fighter. I didn't train for that. I didn't put into work after hours all night long studying the movements, all this stuff. So how could I expect to be an expert in that field? How could I expect to have conviction? So I make it a point to read one book a month, and it's very easy to do. Just to rattle a couple off the top of my head, The Intelligent Investor was a good one. Random Walk Down Wall Street, Stocks for the Long Run, Rich Dad Poor Dad. There's a ton. I read a ton of books, but you know, the power of reading is very underrated because I'm in a camp that whoever I take advice from or listen to, I'll listen to anyone, but the people that I put more weight on my advice is the people where you go and you Google their name and then you say net worth after it and it says multiple millions of dollars or billions. But for the typical person, if they go into a trade, let's just say they went and bought call options on Nvidia before earnings a couple days ago. Okay. They're going to go read a news article on CNBC wrote by some dude that probably has $500 to his name, no money invested, doesn't know anything about investing. They're going to listen to his advice, and then they got smoked because it fell after earnings. So, people need to be careful who their mentors are or who they take advice from because you could get smoked pretty quick in the stock market.
True, true.
Um,
Dude, I want to expand more on following the people, right? Who you listen to, who you see your mentor is, right? In your early days too, you experienced losses following those gurus like the Tim Sykes, right? And who manipulated like low cap stocks, like you said before. What was your biggest takeaway from this experience, and how did yes you went more towards the Warren Buffett side of it, but more than that, how did it shape your current approach for the risk management as well as the investing?
So that's a really good question. So when I did the whole Tim Sykes approach, I was like this like chicken with my head cut off, glued to my phone, waiting for the text message to come through to make the trade, to only be in the trade for 10 minutes and then to get out. And by the time I got the text, it was already 5 minutes delayed. So then literally 2 seconds later, he was already out. And it's like, how do I make money doing this? So I'm a huge proponent of simplicity. I want to keep things simple. I was just in a space on X the other day. I'm not going to say who was in there. It was very big account, like, 500,000 subs. They invited me on. And they're talking about all this financial jargon and interest rates and spreads and liquidity. And I mean, I understand what it means, but at the end of the day, it pretty much doesn't matter. Like, you're just trying to go in here and act like you're smart and know what you're talking about, which, yeah, they do know what they're talking about. But it's like at the end of the day, the number one thing that moves the price of a stock is what the earnings do. If the earnings grow at 20% and a stock goes up 20%, that's justified. And then you could find discrepancies whether it went up too much or not enough, and that's how you find, a deal in a stock or something like that. So Tim Sykes definitely made me understand that don't believe what everyone says online. And just because he was able to do it doesn't mean that you could do it. Just because of how I explained how it works, how he goes in and then is following and then he pulls out. I just wanted something simpler because when I got started, I didn't want investing to take up a lot of my time. Like I still liked my day job. Like I was new into the field. I was, only out of college for a couple years. Um, so I was still excited to go to my day job. Doing the whole Tim Sykes thing and I lost money. It's like, screw this. I'm never doing this again. I'm done, which is how most people are with investing.
Yeah, I was in a college too, and I used to see a lot of ads from Tim. And like at some point, it was so convincing that I wanted to get into, but I kind of shifted my focus to crypto. There were a lot of teams in crypto. It's all pump and dump, not all, but most of it is like pump and dump, right? They
Mm-hmm.
build a community of 10,000 people, and they buy the token, they kind of pump it up, and then they just make them the exit liquidity. Like yeah, so that is part of it, right? When what I've found, uh, people who watches this kind of podcast, right? Many people struggle to shift from a traditional mindset of kind of working for money to making money work for them, right? How did you
Yep.
break that mentality, right? What advice would you give to others that who are like really caught up in this cycle
The
for
number
trading time for the money? Yeah.
It was when I read Rich Dad Poor Dad. That was when I flipped that book. Robert Kiyosaki talks about it. Warren Buffett has famous quotes where he'll say something along the lines, if you don't learn how to make money when you sleep, you'll work until you're dead. Rich people don't work for money. I know that people are going to disagree with me, but they don't. I mean, I don't claim that I'm rich at all, but let's just keep numbers simple. I have $1 million in the stock market right now. If that makes 12% a year, I'm making $120,000 a year for doing nothing, legit nothing. I could just lose my password for, I get it that every year it's not going to be 12%, click, click, click. It's going to go down 10 and then up 20, whatever. It's going to bounce all around. But when you zoom out, 12% a year roughly is what I expect between VOO and Triple Q split 50-50. So, you know, now everything in my life is like an arbitrage of time is an arbitrage of time and to get my time back. So for example, I have a housekeeper clean my house every week because if I could pay her, she spends 6 hours cleaning the house and I give her $200. I mean, divide that out. Is my money, is my time worth more than that? I could focus on making another YouTube video or just focus on reading another book. That maybe that book could give me another tool in my bag to be able to have another investment potential, when it comes across my desk. But, I'm not going to go outside unless I want to. I'm not going to go outside and wash my car for 3 hours when I could pay someone $60 to do it. Is my time worth $20 an hour? I think so. Not to sound cocky, but like you got to eventually put a value on your time. And it's important that if I free up 3 hours to not go wash my car, I need to use that 3 hours to do something productive. I don't really go use that 3 hours to go play video games or something. Like, sometimes I'll go do dumb stuff to just kind of like turn my mind off. The number one thing, I mean, it's kind of hard to explain more clear, but like the rich literally don't work for money. They make their money work for them. Um,
That is
you get
true.
in a terrible mindset when you try to trade that. And actually, one more thing, I watched a good video from Alex Hormozy. A lot of people probably know who he is. The reason why people trade time for money is because they're setting their sights on to make their first $100,000. So when you want to make your first $100,000, it's easy to trade time for money because you can make $10,000 a month for 10 months and you have $100,000 in simple terms. But if you say, I want to make my first $10 million, you can't $10,000 your way to $10 million. The numbers just don't work. So you have
Yeah.
to think bigger. And that's what I think most millionaire investors do.
That is a good analogy. Coming over to the overcoming challenges, right? Your selling put options, especially, has become
Mm-hmm.
your primary strategy for generating steady cash flow. Can you walk
Yeah.
us through the moment or a series of events that led you to realization that, and why do you believe like selling put offers more probability of success compared to others?
Good question. So I was actually just strolling through YouTube years ago before I started doing this, and I got clickbaited onto something. It was like Warren Buffett. This is when I was on my Warren Buffett kick, and it said the only options trading strategy that Warren Buffett does. And I'm like, all right, I'll click on it. So I watched the whole video, and I think the story was in 2008 when the banks crashed. He sold a bunch of put options on Bank of America, and he generated, I don't know, $500 million in premiums because he was okay to buy Bank of America for the strike price that he had it at. So then that really just spurred the whole thing into put options. And I explored all options in general, every single strategy, buying calls, selling, buying, selling, everything, spreads, condors, all this complicated stuff. And I was in the camp that I want to know every single potential outcome of if I buy a call option, sell a call option, buy a put, sell a put, whatever. So I came to the conclusion that, and what I talk to people in my Discord and X about all the time is I'm in a camp that I want to hit first base and second base hits all the time versus home runs with the chance of striking out. And the reason why I say that is if you buy call options straight up, you need the stock to do one thing and one thing only. It needs to go up. If it doesn't go up, you're going to get 8 on time decay. The contract is going to go down in value. If it goes down, you're going to get smoked. So you really need to have ultra high conviction that the stock is going to go up in your time period. Do I use call options? Sometimes, but not all the time. Mostly I sell the puts. Now, when you sell the puts, the way you make money on that is the stock could go up, you make money. The stock could go flat, you make money. And the stock could go down to your strike price and you still make money. In the stock, so for example, I have a bunch of puts that I sold on Triple Q where my strike price is, most of them are at 350 right now, but I have a couple at $400. So people will blast me in the comments and say, dude, you're going to get assigned so many shares of $400 a share. But the difference of mindset is I hope I do, because look at the discount that I'm getting to buy those shares. And guess what? Like I usually sell puts in like 10 contract blocks. So most of the time I make like $20,000 when I sell those puts. So $20,000 on 10 contracts is $20 per share of premium that I'm getting. So if my strike is 400, I really don't lose money till 380 because I'm just losing my premium as it goes from 400 to 380. So what are the chances that Triple Q is going to fall from, what is it, like 480 now to 380? And most of my strikes are probably 6 months to a year out from right now. Possible, not likely. But I don't lose sleep at night with those trades out. But, when I buy calls on stuff, I need the stock to do a definitive move, and that's up. Now, people are going to say your gains are capped when you sell puts because, you could only make what the premium is. I get that. But I would rather have consistent wins over these volatile big wins and big losses. Like I just want something that could scale with me. So as my portfolio grows, I want to be able to scale these puts. I don't want to take on more risk by just doing bigger call options. So, I went on a kick. I'm not going to lie. When I started looking into puts and selling options and how there's 2 people on each transaction, I'm selling it to someone and they're buying it from me. And it took me a little bit of time to actually click in my head to understand it 100%. And I think, people that I talk to, my friends, they don't really understand it. They're like, well, how much money do you need to be able to buy the puts that you're selling? And I'm like, we're not buying anything. We're selling the puts. So it's hard for most people to get through their head, but I watched I watched probably literally every single YouTube video I said, why is selling puts bad? Why is selling puts good? I'm talking to ChatGPT. I'm Googling it. Like I want to get every potential input into my strategy of why is it good and why is it bad. And then at that point, I will make my own decision if I like it or not. Now, I will say, I don't sell puts all the time. Like when I feel like the market is overvalued, I will not sell puts. I want to sell puts when the market I feel like is undervalued. And I also like to sell puts when the market is red because I'm kind of going on a tangent here, but this is like my quick little example. Let's just say you live in Florida and you call your homeowner's insurance company. You say, I want to buy flood insurance for a 1-month duration. They say, okay, there's no storms on the horizon. It's $100 for a month. Great, you buy it. But let's say you call them back again and there's a hurricane en route in the Caribbean somewhere. And you say, I want to buy it for a month. They're going to say, well, it's $1,000 right now. You say, dude, it was just $100 a month ago. Why is it $1,000 right now? And they said, because we think there might be something bad coming, so we're going to charge you more for that premium. So when the market's going down, the market interprets that as something bad is happening or is going to happen. So people are willing to pay more money for put option premiums. So when people are willing to pay more for the premiums, I'm getting that money. I'm getting more money in premium. So it's a psychology game. It's all about mindset. Like I know you're hitting on, the emotional and psychology part of investing. Like you're 100% right. That is what 90% of investing is. It's just arbitraging. Like I view the stock market as millions of emotional hypermanic, crazy people with their heads cut off. Like, oh my God, it's worth this. Oh my God, it's worth this. This is going to happen. This is going to happen. But it's like, most of it is all noise.
It is.
Um,
It is. I really love it. I want to add on that. You have to train yourself to react rather than predict. Once, like you said earlier, right? A lot of people, a bunch of people are predicting where the market is going, whether the market is going up or down or sideways or blah 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 blah, right? And those are the noises. We have to, even if it is coming from Warren Buffett or it is coming from anyone, um, from the top hedge fund, right? Those are just a
mhm.
noise. You have to see how the market reacts, and you have to react in that way too. Yeah. That is interesting. What about your criteria? Like, how do you ensure you would be selling puts options? And again, you really said a good point on you don't mind getting liquid, not liquidated, but coming to the point where you have to exercise your put options, right?
Mhm.
How do you don't want to avoid it, but how do you kind of prepare yourself, right, to cover up all of those exercise in the worst case scenario, exercise all those put options.
So that's a good question, and a lot of people ask me that. So I'll hit on the criteria part first. Like I said, I don't sell puts all the time. If I feel like the market is overvalued, I won't do it. And I'll kind of like put this pencil on the screen to kind of make it make sense, I guess. So just correspond this is earnings growth of companies in the triple Q in, let's say, a 1 year time period. So if this is 0 to 10% right here, that's what the earnings growth of the companies do. If the stock price is up here, maybe this is 10% growth here, but the stock price is at 15%, the market moved more than what the earnings growth did, so that appears overvalued. And then if the market went up say 5%, but the earnings growth was 10, the market appears to be cheap. So I like to look at things like that, and that's also like PEG ratios, price earnings growth ratios. It's like a double whammy. Like you want to sell puts. So like here's like my criteria for triple Q, for example. If I were to sell a put right now on the Qs, which I'm not going to because I feel like it's slightly overvalued. Um, if triple Q is 480 right now, I would sell the 440 put for a year out from right now. I get 20K in premium. My goal would be to have triple Q stay above 440. I don't ever touch the shares. Now, if I get assigned the shares, that's fine, but it will be scary if I get assigned a bunch of shares of triple Q because I've been assigned before, and this is kind of how my assignment went down. And this is kind of when I started out and I didn't know about the wheel strategy. I mean, I knew about it, but I just was kind of nervous and didn't want to do it because I didn't want to sit on margin. So I sold 10 contracts at Triple Q. This was years ago. I think the strike price was like 350. So I was assigned 1,000 shares of Triple Q at $350 a share, and my account went on margin for $350,000. So my cash balance was negative 350K, but I had these shares. So it's not like you're just like on margin and you have nothing in return. I have $350,000 value worth of these shares. So I was assigned on a Monday night. I woke up Tuesday, my shares are there. What happened was, and you could say I got lucky, but the price of Triple Q actually went up on that next day. So I was assigned the shares at 350 and I sold them for like 355. So I made $5 a share times 1,000 shares. So I made $5,000 on the assignment plus the premium I received. Now here's the flip side. People are going to say, well, dude, what if it would have went down? Of course it could have went down. But this is where I'm going to flip it and say, only do this on things you're okay to hold for the long run. I had someone in the comment section yesterday say, yeah, selling puts, it's great. I sold puts on Rite Aid. It's like a pharmacy in the US where they're going bankrupt. And I'm like, dude, that's not something you want to hold for the long run. Like, if you do it on Triple Q, like, here's my thought process. If Triple Q goes bankrupt, which it technically can't, but if the companies within the Triple Q go bankrupt, we have way bigger problems than money in this world. I mean, we're being abducted by aliens or something crazy is happening. Like, money is not going to be an issue at that point. So, yeah, I was assigned to shares, sold them, made money on them. I sat on margin for 3 days because it was T plus 3 back then. T plus 3 is like it takes 3 days for the trade to clear. And even though you close out the trade, you're still on margin until the trade is cleared. If I were to get assigned right now, I think I have 20 puts right now. They're at a 400 strike and the rest are at 350. So if I get assigned on those 20 at $400 strike, I'm going to be on margin for 800 grand, um, which is a lot for sure. But as long as I could generate more premiums by selling calls than what my margin interest is, I'll just sit on that all day long, because I am in the camp, and you could say that I'm a permabull. I mean, permabull is a term that is relative to time. I'm a permabull in America on like a 5 to 10 year horizon. I mean, the longer the better. But in the next year, do I know what Triple Q is going to do? No, I don't. I don't claim I do. But I'm just playing like a statistics game. I'm saying, is it going to go up? Great. I don't care how much it goes up. Is it going to go flat? Maybe. Is it going to go down? Maybe. But is it going to go down this much? And my consensus when I sell these puts is I don't think it is. That's why the highest strike price I have right now on the Qs that I sold puts on is $400, and it's 480 right now, because when I got into it, I felt like it was undervalued. So that's the key. Most people in the stock market, they do everything backwards. They buy high and they sell low. I like to buy low and sell high, but in puts it's reverse because you're short the contracts. But yeah.
Yeah, there's a lot of people that I've met, and all they do is buy call options and hope is not a strategy, and hope the market goes up, right? And they blow up so much money just doing that. Yes, they may make money a couple of $1,000s, but it goes back to someone who is selling it. It is really weird. Talking about being patient and waiting for the right market condition, right? You mentioned the importance of being patient and waiting for the right market condition to sell your put options, right? Can you elaborate like what indicators or signals that you look for before you decide, okay, it's time to execute a trade, and how do you balance that patience with your action?
Good question. So how do I know? I like to go back to the earnings growth. I don't really look at charts a lot. I know a lot of people are going to blast me. And there's a lot of technical analysts that do make money, but if you're going to buy a company straight up, there's like any company that's not even public, you're not going to look at what their Fibonacci retracement was 5 years ago or whatever it was. Like, you're going to look at how much money you make. That's what moves the market. For example, a couple of weeks ago when we had that stock market dip, I think the Qs fell 15%. What was that? The Japan carry trade. People were scared there's a recession coming. Consumer data came in soft, stuff like that. So what I did in that time frame was I did my own research. I had researched what the Japan carry trade was, because honestly, this was the first I've ever heard of it, and probably for most people it was. I researched the consumer, and I happened to be in Vegas that weekend, and I'm looking around and I'm like, does this really look like there's a consumer recession right now? I mean, it sounds like stupid and like basic, but like, dude, Vegas was freaking packed out of the wazoo. There was people everywhere. Like, we couldn't even get a dinner reservation. So I'm like, and Vegas is like a good, like market feeler, because people from all around the world come to Vegas. I felt like that dip was overblown, and that is when I bought call options actually. And kind of my criteria is, if I have supreme confidence, like 99.9% confidence that the market's going to go up, I will buy calls because you can make more money. But if I want to have the flexibility of it going up and maybe not a lot, I'll sell the puts. So when that dip happened, and it was also after Warren Buffett sold some of his Apple stock, guess what I did? I sold puts on Apple. I got in at a discount, and usually the best days in the market are after the worst days in the market. So when there's this super sharp V shape going down, people are freaking out. But when you catch the bottom of the V, which is not exactly easy to do, it usually bounces up the hardest. Like I said, the best days are after the worst days. And that was when there was like peak pessimism in the market. It's like that example I gave you on the Florida thing where there's a storm coming. The market was down. People thought there was a huge storm coming. So I generated fat premium selling puts on Apple, because people are like, the market's crashing, the consumer's bad. Apple's a consumer-based company. Warren Buffett sold half a stake, which we could go into that why if you want to. I think I know why. No guarantees, but I think I know why. And
We,
yeah,
we, we
so,
can we can talk about that.
okay. So I'll just hit on that real quick then. So I listen to Warren Buffett's annual shareholder meetings every year. They're like 4 hour long videos on YouTube. Usually CNBC or Yahoo Finance puts them on. And I never would have knew this unless I watched that. But Warren said maybe 2 years ago, he said something along the lines of, once you own more than 5% stake in any company, it becomes complicated. And he said something along the lines of, like, if you own more than 5%, you are considered to be I forget the exact term, it's like a substantial shareholder of some sort, like you own a controlling stake in the company. He's under so much more regulatory scrutiny. Like, if he wants to sell those shares, I think it has to be pre-planned when he gets out of them. He can't just go and pull the trigger and sell the shares. So these shares of Apple that he sold, most people didn't catch it, but they were pre-planned to be sold because he owned over 5% stake in a company. It's worth it for him to stay below 5% stake. Now, what the typical person's going to say is, well, how did he get over 5% stake? So when he entered into his Apple position a few years ago, he bought like 3.5% of the company straight up. Now, what happens is every year and every quarter, Apple repurchases their shares. So if Warren owned, let's just say there was 10 slices to the pie, but if Apple repurchases their shares and they take a whole slice out, Warren doesn't own 1/10 of the pie. He owns 1/9 of the pie. So his percent ownership of the pie as a whole naturally goes up by him not buying any more shares. So that's what most people don't understand. And what will happen is, if Warren stays in Apple forever, um, he will have to sell more if they want to stay below 5%, because they are going to continue most likely to repurchase shares, and that's how his stake will naturally go up. So that is also why it favors a long-term investor to stay in these companies, because you're owning more of the company by just sitting in there doing nothing. Something to take note on that. And also, Warren has always said he would much rather own companies as a whole versus just like a 5% stake. So for all we know, I mean, he wanted to get below the 5%. He wanted to put this money in cash. And for all we know, maybe in the next couple months or so, he has some big acquisition of some company that he's going to use that money for to buy. We don't know. We'll hear about it after the fact. But people were so quick to jump on Buffett's out of Apple. He doesn't believe in it anymore. It's done. Apple's his number one holding in his whole portfolio as a whole by a factor of like 2. And I think the next one is Bank of America. So he still has a lot of confidence in Apple, or I think he would have sold all of it for the most part.
I wanted to know, you did mention about having a put option, especially the contract, right? The contract, when we talk about the option contract, it has multiple things, the length of the contract, the strike price, right? Premium and all those things. And as the time passes by, the premium for the buyer, it increases, for the seller, it decreases, right? Um, how long do you stay in a trade if you're selling put option? Do you wait until all of it expires, or do you kind of get in the middle when the conviction doesn't hit right, or like how long on average do you stay on that trade?
That's a really good question. So number one, I like to layer my trades so that, let's just say that my portfolio has the ability to do 10 sets of trades, whether that be 10 contracts or one contract, whatever it may be. But I'll space that out over the course of 10 months so that if my average duration is just, say, 10 months, every month something is expiring and then I could redo another one so that you kind of layer it in together. But when do I stay in the trade for? It depends. For example, I have one that's a 350 put on Triple Q that expires in like 2 months. For me, so I sold that contract for like $20,000. For me to buy that one back, it's like probably $1,500 right now. So I realized like a 90% capital gain on that. So do I want to buy that back to get more buying power to go do more? Not right now, because I don't have another trade that I'm willing to do right now. So, yeah, it's great. I made 90% return on that, $20,000 to buy it back for 1,500. But if I don't have another trade, there's no point to go buy it back because I don't need that buying power. And I mean, that's just $1,500 that I'm leaving on the table too. Like, I'm not trying to be greedy and get every penny out of the trade, but the likelihood that the Qs are going to fall to 350 by December or whenever it expires is extremely unlikely, in my opinion. So I'm going to let that one ride out. But let's say that I have a huge trade that I want to do and I need the buying power. Then I have things that are up 70%. Like, I'll close them out if they're up 70%. It kind of just depends on the situation. Also, depends what I want to do with taxes. So right now, I have like Hope the IRS isn't listening, but it's really not that big of a deal. I mean, I have a couple $100,000 of unrealized capital gains right now in my portfolio. Now, a lot of that is just owning shares straight up, which I won't really ever sell. But a lot of it, probably half of that, is put options. And the issue is, I try to push all my durations to 2025 so that if I want to defer the taxes for another year, I just won't close those out until like January of next year. And I don't have to realize that on my 2024 tax return. So that's also a consideration too. Um, and whenever, if at all possible, I always try to do tax loss harvesting just to help out with, trying to put on paper that I lost but really make money in a real term. But for when I close them out, yeah, I mean, if they hit 70%, I'll start to consider, but below 70%, I don't usually close them out. Um,
Makes sense.
because I just feel like it's just money left on the table, honestly.
Right, right. Yeah, yeah. That is interesting. We're almost getting to the end part of it, right? For those who are just starting their journey, who are stuck in this 9 to 5 job, right, and they are saving money, what advice would you give them regarding the investing, trading, the principles, right, and some kind of obstacles they might run into, and how much fun do you think they should have before they should even think about investing?
So that's a really good question. And I'll kind of answer this question as if I was talking to myself when I got started.
Okay.
Um, you're not going to get rich overnight. You're not going to get the needle in a haystack and buy the call option and 50 extra money. Don't buy into meme coins. People will come to me and say, I have $500. What do I do with it? And I'll usually say two examples, two things to do just depending on what I think at the time. But I'll either say, go buy one share of VOO and hold it forever, reinvest your dividends, or go spend $200, go buy the top 20 books and read the books from cover to cover, every single book, and it'll probably take you a year to do it. But when you come out in 1 year, you will know more than 99.9% of people on earth about investing. So if you have more information than them and you know more about it than them, how can you not beat them at their own game? Um, but the problem is that people don't want to put into work to read those books. And I'm not going to lie, a lot of the books were dry and I hated them. But I, the pain of reading those books was less than the pain of being stuck at my 9 to 5 forever.
Yeah.
So I just waited out, like, what pain am I going to take? So I took the pain of that. And also, like, find time in your day, just work it in your day to be more efficient. Like, for example, if I'm going to go drive somewhere and let's just say it's a total transit time of 1 hour driving, I'm not going to listen to music in my car. One of those books that I'm talking about, I get the audiobooks. So for example, I'm reading a book right now called The Motive. So I have the Amazon Audible book for that and I just listen to it and it reads it to me. So that's how you get through way more information. And the books that have like charts or, figures that you need to look at, I'll just go back when I get home and just look through them charts real quick and then I'm done. But that's how, you could squeeze another hour out of your day every day. And if you do that in a month, you just read 30 hours of books. I mean, that's probably 2 audiobooks right there. So you got to take it serious. It's not easy. It's not going to happen overnight. I cannot stress enough, and you were stressing on it too a lot, the emotional aspect of investing. Um, Good book was The Psychology of Money. That was a good one. Irrational Exuberance was another good one on that stuff. For the typical average investor, if I explain in one sentence what to do, dollar cost average into the S&P 500, hold it forever, never sell, reinvest your dividends, and don't listen to what anyone else has to say. That's it.
That is amazing advice. That is true. Um, and at the end, no matter what you see, no matter what you hear, right? If you don't put in the amount of hours that is required, you're not gonna get anywhere. That is very simple. Yeah, you might make money. You might make $1 million, definitely, but you're gonna lose it too. This is not 100% sure, but yeah.
But here's the one thing. This is the last thing I want to say on that too, and it's what blows my mind is people have no problem working 40 plus hours a week at their day job, trading their time for money. They're trading all this time, all their life for this thing called money. But then when they get this paycheck, they don't know what to do with it. Like, why are you trading so much time for this thing that you have no clue what to do with it? Like, why can't you spend 1 hour a month figuring out what to do with this money that you work so hard for? And I mean, put a value on your time. Like right now, we appear to be healthy people. Um, think about time as a constant. When you're 90 years old, what is the number one thing that matters to you in your life? Your time. So if you're trading your time for money right now and making $40 an hour, whatever you're making, just think about the tail end of your life. Are your last hours of your life worth $40 an hour to you? I mean, it's totally just that it's the same amount of time though, but it's just not. So, you know, figure out what the value of your time is.